Lori, I'm going to go to you because you are exquisite at something no one talks about anymore, not the Red Sox middle relief, but small cap stocks. And the answer is small cap stocks do nothing, and then about every 9 years, boom. Yeah. Are we close to the small cap boom, and why?
Small caps are in a holding pattern right now versus large cap. I think they're waiting for their moment to
shine. Like what, 7 years?
Well, they actually have had a terrible last year and a half.
Okay.
And actually, they've been bad for quite some time. But I think really around 2014 was kind of the last moment in the sun that we had there. But look, I think small caps are telling you that this is a market that wants to start bottom fishing, where people are starting to look for things that have been de-risked. And when I talk to investors about areas of the market that have been de-risked, small cap is the #1 thing that looks like.
But are they small cap because they're zombie companies or because their managements do not merge into mid cap size? What's the pixie dust of why they underperform?
There's a few different versions of it. There are the younger growth companies that are still up and coming. There's some that have been older and fallen on harder times, and then there are others that are simply a little too niche and haven't gotten scooped up yet. So there's a big variety in there.
David, a lot of this hinges on inflation getting back to 2%, as so many people believe. And this is the distinction people are drawing from the terrible 70s, saying this is different and it is less entrenched than some people fear. What is the risk that that's not the case, or is it a screamingly obvious argument that the Fed will get things back to where they want it?
The Fed will do everything it can do, but it may have a bitter medicine for the economy. So I do think it's instructive to look at the 1970s and try not to repeat those mistakes. It's early in the 2020s. From 1975 to 1979, real GDP growth was 5% plus. So real growth is not going to be that strong in the United States. It's really important that inflation does work its way back to the Fed's target of close to 2%. That's going to require the Fed doing its job, fiscal discipline, and most importantly, a renaissance, once again, like in the early 1980s, of the supply side. Reaganomics combined with Volcker's monetary medicine is what laid the seed for a very good 80s and 90s and thereafter. So we need to learn the lessons of the 70s and not repeat the mistakes.
Meanwhile, as people do bottom fish, and Lori says there's evidence from the small caps, how much are bonds participating in this? Has the stability in longer duration bonds provided a template for that bottom fishing, for that comfort that could even persist longer than people think?
I think investors are better off for now in short duration bonds, treasury bills, 2-3 year treasuries. The bond market's not priced for the Fed getting to as high as 4%. And neither is the equity market. That would be a risk. So I think investors should be careful with bonds, look for inflation protected bonds, hold on to cash, and then look for real assets, whether it be stocks or real estate or utilities. I do like small caps, and I do like banks for those who are willing to take the cyclical risk. I think small caps have been beaten up even more so than the large caps. And what's interesting about small caps, they were held back over the past decade or two from globalization and other factors. They will benefit more
Lisa,
now.
we got a problem here. Our guests agree with each other.
Yeah, we agree.
Okay, well, here, I think
you and I never agree. They agree.
That's right. That's why we're put on the couch together. I do wonder, though, we're all talking about the United States. We have to zoom out. It is not about the United States right now. It is strong in the United States. In Europe, it's another story with gas. And we are looking to the ECB next week. We are looking to the Nord Stream 1 pipeline, whether it will come back online. We are looking to emerging markets. Tom has been talking about it all week, and some of the crises percolating in pockets throughout the entire complex. At what point can the United States fall subject to what's happening outside in the rest of the world, Lori?
Well, look, I think we had a template for this back in 2018. We spent most of the year thinking the U.S. would be immune from the global recession that would emerge from the trade war, and then recession fears came home to roost and markets fell sharply. But we've already done that at this point in time. So I think we can go back to this idea of a relative game. Will Europe be worse off than the U.S.? If the U.S. is better off, I think there's a limit to the amount of cash that institutional investors in particular are willing to sit on. So a lot of that money is going to find its way into the U.S. and the small caps.
David, I want to go to the heritage of DWS and, of course, the relationship with Deutsche Bank and the giant David Folkers-Landau, who on February 24th or 25th told me, watch the dollar, this will need to be amended. We are now living a dollar surge, and I'd say this week, folks, DXY, the blended large large nation index was caught up with late in the week by the Bloomberg Dollar Index, more EM. David, how do our listeners, how do they adapt to an incredibly large, strong dollar?
It's a tough thing to adapt to. Don't forget the S&P 500, not banks, but the rest is a very global set of businesses, and they're facing foreign exchange rates, and they're going to be facing tougher competition in the areas of auto and machinery and tools from Japan, incredibly weak yen, and Europe, and it's a slower global economy anyhow. David Folkets-Landau from Deutsche Bank was one among the first to warn of a recession coming, and at DWS, the asset management business, I do believe there will be one late this year, early next.
Lori, linking your work with Tom Porcelli right now, he's truly expert on wage growth or the lack thereof. What does terrible real wage growth mean for our listeners?
Well, look, it reduces consumer spending power at the end of the day. There's a weakness, right, to the undercurrent of spending.
Is that what we're going to see in the coming weeks?
I think that you have seen a few companies already allude to the idea that there have been some hits to demand if you read some of the early reporters. So I think that's something we have to watch out for. I think the country's in a little bit of a shell shock at the moment with all the recession talk. But I think that's really, you know, this idea, sort of this undercurrent, this underbelly of weakness that is not captured in the headline data is something to watch out for.
With the data dependency of the central banks, with the data dependency of traders looking at some of these wow statistics that we were just talking about this week, David, what are you trained on to give you some guidance? Because we were talking about the University of Michigan controversial sentiment data and how much people are really trading off of that. What's your compass?
My compass is actually not the consumer. I think the real concerns are on the supply side, something we've taken for granted for 40 plus years. So I'm watching the global economy, I'm watching the conflict, I'm looking at policies both in the United States and Europe and seeing if they're more pro-supply side than they have been in recent couple of years. So I'm trying to get a big picture idea because I want to step up and buy when we have a recession and equities get hurt perhaps a little bit more. But I want to be more confident this is going to be a good decade. And I think we need some better policies. And if we look back and see the 2020s turn out to be another great decade for stocks, I think healthcare will be a big part of that.